an amazing team of people, and you're going to be excited about what you see today.
Thank you very much. Well, thanks for the generous introduction. I just actually got off a meeting with another group. So every Thursday night we do a Zoom call where the meeting that we're going to do tonight, the things that I'm going to talk about tonight is the exact same thing that we do every Thursday night. So every Thursday night, 7 p.m. Central, which will be 5 o'clock California time, we put on, basically it's a client presentation where we present the ideas of the trust or any type of financial structure or strategy. A lot of times in the meetings, people bring up all types of different strategies that people know about. Maybe they have an IRA, or maybe they have a captive insurance company they set up, or any type of tax strategy or structure. So I have about 21 years of experience. I started out at American Express Financial Advisors. I had all the licenses you could have, and they trained me for years on how everything works, and the financial planning company. So now American Express Financial Advisors is now Ameriprise Financial. So they switched their name, but when they went to Ameriprise, I left and started my own company. And so, but after about 12 years of running my own tax strategy firm, I joined the Nexus Group, and I'm the managing trustee over all of the agents and all of the people. And so, but our goal is to help our clients do the best for themselves financially, but number one, save on taxes, asset protection. I'm going to show you all the things that we do in a PowerPoint tonight, but we also have some images that we like to look at, and we also like to use a whiteboard. So hopefully you're going to be able to see me answer a lot of questions about the trust and how it will help you. And it's also an interactive meeting, so if you, in a little while, I may ask you about your situation or how it might. Because the purpose of our meeting, the client presentation meeting, is to help the client. So if you have a specific question about maybe you own a business, ask me a question about your business so I can answer the question. And what happens is everyone will benefit from your question. So who are we? Nexus International. We are an asset protection firm. We use highly unique trust products to provide three main things: anonymity, which is called invisibility. People like to be invisible. Anonymity, asset protection, and control. And then the best thing is powerful tax strategies. So if you have a business, if I can show you how to cut your tax bill by 90%, what could you do with that extra money? Anything, right? Well, what we do is we want to show you tonight, when I show you how the trust program works and how it actually functions, and it has been functioning for almost 500 years now, you can take that extra money and do stuff like what April does. You can put the money in if you're going to save the money, you might as well put it in something that can parlay the money better than any other thing out there. And so that's why we partnered with April and the group here, because they seem to have the best product that can do that. So I have a policy myself. So who are we? We are a tax strategy firm, asset protection. Let's go through just a few of the slides about what we do and how we help our clients. We're in DFW, right by the airport. People fly in, they come see us, they set up a trust, they go home. We'll spend the whole day with the client. So we'll take them through the trust. We'll go page by page. We'll explain how everything works. But we also, by the way, I have a trust in my bag back here. After this meeting tonight, I'm doing an activation up in San Mateo, I guess, not far from here. So I'm doing an activation for a client up there. So I'm taking his trust up there, and we're going to sign all the documents in the trust, and we're going to set up his trust tonight. So I go, not only do people come to us, but we go to the client too. So it's not a problem for us to go meet people. So who are we? We are a financial planning company. We don't do a financial plan for everyone. They may not need a financial plan, but we do a financial plan if they need it. So we can do a 21, 25-page financial plan for someone, explain to them how to get out of a problem they're in. So if someone comes to us with a very unique, type of situation, hey, I have a tax problem here, I have the IRS on me for 3 years of back taxes, I have this problem happening, they have all these things happening all at once. And how do they get out of it? They don't know which thing to do first. So we can put a plan together for them these are the things you do first, then you do this, then you do this, and this is why you do this first. And this. So one of the things I tell April all the time is that a lot of times people will go and they know their brothers, maybe their brother's a CPA or their neighbor is a tax accountant or something, and they will go to someone who may not be an expert at something. They'll have a good strategy, and so they'll say, hey, do this will work. The problem is when you do a strategy where people say, hey, this will work for you, it's like when you take a rock and you throw it in the pond and it ripples all the way across the pond, right? When you make a change over here, it can ripple effect, it can mess up things on the other side of the pond. It can affect other things that you do. So you make a change over here, but then it just messed up something real big over here. So what you have to do is you have to take a step back, you have to look at the big picture and see, you have to take a step back, look at the big picture and see if I do this, how's it going to affect everything else? So you have to be aware of what you're doing when you do it. So that's what we do at Nexus. So you can keep your trusted advisors. You're not required to, let me go ahead and do the slideshow here. You're not required to use only us, okay? You can keep your trusted advisors. You can, let's see. It's not showing my screen here, April. Oh, is that it? Hold on. Let's see if I can get it to work there. Yeah. Hopefully she'll fix it. But the whole point is you can keep your advisors. You don't have to. You can work with us. We can use our people, or you can use your people, and we can still help you. Because when we set up a trust for someone, we can work with their attorney or with their CPAs. They can still use their bookkeeper. They can still use their financial planner, whatever. We act as, we take whatever role that you want us to take. But again, we can take the role that you want us to take. But my goal tonight is to show you what I call the 5 living benefits. So if you take a phone book, it doesn't matter, pick your poison, take any phone book in any city, in any state in the United States. Take the phone book, open it up to the lawyers section. Call any lawyer and say, hey, I want a trust. 99% of all lawyers are going to sell you either a revocable trust, a revocable trust, or a living trust, or a simple trust. Even if it's an irrevocable trust, they're going to sell you as a simple irrevocable. They're not going to sell you a complex irrevocable. So they'll always sell you the wrong structure, so you never end up getting what I call the 5 living benefits. So okay. So what we're going to do is we're going to talk about the 5 living benefits. So the first living benefit is asset invisibility. So when you have a lot of assets, you own a business, what you want first, you want your assets to be invisible. You don't want the assets to, you don't want people to even necessarily know that you own the asset. So asset invisibility. The next thing you want is asset control. Okay, so what I like to do is I like to explain, and I like to use the whiteboard, by the way, so because I like to draw things out. And so every Thursday night when we do our meetings, I use the whiteboard on Zoom all the time because I just got finished with almost a 3-hour meeting. Yeah.
Okay.
Thank you. All right. So this is my favorite slide of all the slides, just so you know. The reason it's my favorite slide is because I want every customer I have to walk away with all 5 living benefits here. Okay? I want every one of my customers to have asset visibility, ultimate asset protection. When I say ultimate, it means that no judge, no courtroom in the whole United States, no IRS, no one has the right to have access to your assets in your trust. Even the IRS. Okay, they don't have access. My goal is for every one of my clients to have all 5. Guess what? If you have all 4, then you're going to get the last one, which is called true peace of mind. So my clients are able to sleep well because they know not only are their assets invisible to the world, or that they're invisible, their assets are invisible, but they know they can never lose the asset, they have complete control of the asset, and then they get to use those assets to do what? To create the ultimate tax benefits. That's how it works. Not only can you not see it and you can't take it, but they get to have the massive asset control in order to get the best tax result so that they get to sleep at night and have ultimate peace of mind. So that's my goal, and so when I explain how all this works, this is what you have. Now, remember when I said when you open the phone book and you call any attorney or whatever, they're going to sell you one of those three: the living trust, the revocable trust, or the simple trust. Even if they go irrevocable, they're going to sell you a simple trust, and you don't get any of these five. So with an irrevocable trust, with a revocable trust, or a living trust, or an irrevocable simple, which is what 99.99999% of all trusts are, you don't get any of these five. So I'm going to teach you how it works. So just very quickly, I'm going to show you that there's basically two types of trust. You can have a trust that's revocable, okay, which means the person who creates it has the power to end it. They can revoke all the assets and put it back in their name. Or you can have an irrevocable trust, okay? And when you have a revocable trust, they're usually always grantor trusts, okay? Or they're going to be living trusts. This is what you're always going to see. 99% of the time, every trust you see and every attorney that you call to set up a trust, they're going to try to put you in this bucket over here. Again, this bucket over here, you don't get to 5, right? This bucket over here, you have a chance to get to 5, okay? Now, irrevocable, it's either going to be simple or it's going to be complex, okay? The difference between simple and complex is simple. Simple is just like this. So let me explain how this works. I'm going to draw a bucket. When you set up a trust, you're setting up a bucket, okay? If I create a trust, all I'm doing is creating an entity to put assets in. So I call it a bucket, right? So here you are over here. This is you, okay? And you own a bunch of assets. You own a house, okay? You own a car, right? You own, all these assets over here, but you own them in what I call your personal bucket. So what you do is if you take all these assets and you put them over here in the grantor trust, in a revocable grantor or a living trust, again, you get none of the 5 things up there, okay? In other words, if you move all these into here, and let's say you have a creditor or anyone that wants to sue you for any reason, all they have to do is say, Judge, can you please make them come over here into their trust and sell these assets to pay off our judgment? And he'll be like, sure, because he can allow, because these trusts are called statutory trusts. Okay, statutory, meaning they're governed and controlled by states. Okay, the states make the rules for statutory trust. Okay, so again, you sell your assets to a living trust, a grantor trust, revocable trust. You have one creditor. It doesn't matter who it is. You could have a car wreck. Okay, you're one car wreck away from being sued. First of all. And you can have a creditor or a plaintiff's attorney. Okay, plaintiff's attorney can sue you. Anyone can sue you. Guess what? When they sue you, they automatically get to sue your revocable grantor or living trust. They automatically do. If they sue you, they have the right to sue any one of these. So you put your assets in here. Guess what? All they have to do is say, Judge, can you please make them sell these to pay our bill? And he'll say, yeah, sure. Okay. That he will allow them to. You don't give any rights. You don't have any rights. Now, instead of setting up this kind of trust, what we do is we sell the assets over here to a complex trust, an irrevocable complex, okay? And then we add a few things into it. Spendthrift, okay? The Spendthrift Trust has been around 500 years, almost 500 years. The Spendthrift Trust has. So. It came from European common law back in the 1500s. They set up these types of trusts back then. So the trusts that's nothing new. Okay? So when you sell the assets to our trust, okay, an irrevocable complex spendthrift trust, you have all 5 of these things right here. You have all 5. What that means is if you have a creditor or a plaintiff's attorney or you have a car wreck, doesn't matter what happens to you personally, you can never lose anything that you sell of your assets into this trust. Now, you have complete control of the asset. Because here's what I explained. If you sell everything into this trust, if I have the right to take it from you, you don't have control of it. If I can sue you and take it from you, you don't have control. You have limited control. But if you sell your assets to this trust and you have all 5 of these, now you have complete control of the asset. And the reason, and here's why. Here's why you. The reason why you cannot. The reason why you cannot access anything inside of this trust is because of the provision called a spendthrift provision. Okay, the spendthrift provision is a special provision that let me show you. There's 3 parts to an asset. This is what you have to understand. Every asset you own, your car, your house, everything, there's 3 parts to the asset. There's the title of the asset, there's the equity of the asset, and then there's what's called beneficial interest. Okay, so let's take, for instance, your car. If you have a car, right? You say you let your kid drive your car, right? Well, what you're doing is you're letting him have the beneficial interest of the car because he's driving your car. He does not own the car. He doesn't. The title of the car is not his, but he gets beneficial interest. He doesn't own the equity of the car, and he doesn't own the title, but he gets this right here. The reason you can lose everything right here in these structures is because you currently have you have all 3 of these right here. Okay, there's something called a control test. Okay, and the control test says that if you have control, if you have all 3 of these, then you have the right to lose anything in these types of structures. But the reason why our trust has all the protections and all the asset protection is because the Sphincter trust has 0 equitable title. Okay, so again, equitable title means so you have, remember, title, equity, beneficial interest. If the trust only owns title, it doesn't have the other 2. These 2 right here are held in what's called escrow. Okay, so let's follow the bouncing ball. Here's your assets. You sell the assets to your trust. The trust is a Sphincter trust. Therefore, you have what? You have no equitable title to anything in the trust. Who has that title? The trust holds title to all the assets, but it doesn't hold these 2. And the rule says if you have all 3, I can sue and take it from you. But because it's a Sphincter trust, these 2 are held in escrow. So it's kind of like a loophole, basically. In other words, the judge can't take something from you that you don't own. So, in other words, the court doesn't have the right to take something from you if you don't own it yourself. Over here, you own all 3. You own the title, the equity, and the beneficial interest. That's how they take it from you. Over here, the trust only has title. It doesn't have these. So that's why it's held in escrow. That's why, and by the way, that's why anything you put in this trust is not even subject to eminent domain. A city, if they're building a road, they're gonna do eminent domain and just take everyone's land, right? But if you have your land in a trust, a Sphincter trust, it's not subject to eminent domain anymore. Now the city, they have to negotiate with you. They say, hey, we'll give you 10 times the value just to get your land. See, you have power when you have a Sphincter trust. So any asset in the Sphincter trust is not even subject to eminent domain. So again, this is my favorite slide because it really tells you all the things, all the benefits that you're really going to get at the end of the day. So, all right. So we're not the first people that have done this. So I like to show a slide of John Rockefeller. You know, he had this exact type of trust, a complex irrevocable trust, Standard Oil. So John Rockefeller was arguably one of the richest men ever in our country. And he was famous for taking money and parlaying it. Okay, one of his sayings was, "I know ways to make money that you don't know anything about." He was talking about trust. Okay, because not very many people knew about trust back then, and a lot of people didn't know. You had to be in a certain class of people to know about trust back then, and it's kind of the same way today. the people that do have trusts all have the wrong ones, you know. So again, it's kind of the same way today. So he also said, don't be afraid to give up the good to go for the great. If this trust costs money, you know, I don't care what I have to pay. I care what I make. I care what I earn, right? If I can save you $100,000, $200,000, $300,000 a year in taxes, or, you know, if I can save you a lot of money in taxes, you know, the cost of doing that, you know, it's a cost-benefit analysis, right? You know, our fees, we're not the cheapest people out there to do these types of trusts, but I like to think that we know what we're doing. I like to say we're the best. So you're going to get what you pay for. If you buy a $5,000 trust, you're going to get a $5,000 trust. So there's two rules with that. Is number one, not only do you get what you pay for, but you always pay for what you get. So you're going to pay the price for getting the wrong thing, right? So not only are you going to get what you pay for, but you're going to pay the price for what you bought. So so don't be afraid to give up the good to go for something better. And his most famous quote was, own nothing, control everything. Don't let yourself own it. Remember over here, don't get it out of your personal bucket. Get it sold into the trust where you have all the control. See, you don't have control over there. You think you have control, but it's an illusion. Because if I can come and take it away from you, you didn't have control. Over here, you have control. So, okay, so there's a quote that says, never be deceived that the rich will let you or allow you to vote away their wealth. A lot of people are going to say, well, they're just going to change the law. Well, they haven't changed the laws since they wrote the laws, you know. In 1913, when they set up the IRS, they haven't changed the law since. So they always protected the trust. Every time they changed law, they always changed every other law but 643, the 600. So the 600 tax codes have never changed since they wrote them. So they're not going to allow you to vote away their wealth. They use these structures. The politicians, the wealthy, powerful, they use these types of structures. So now this is a slide that explains the key flaw with most trusts. And this is what I said earlier, just illustrated on the whiteboard. But the key flaw with simple trusts is that 99% of trusts are set up as living, grantor, or revocable, which requires you to distribute income and assets. And now, when you set up those kind of trusts, you exempt yourself from the complex trust codes. Okay, so follow my thinking here. Okay, I'm just going to show you real quick what happens when you choose the wrong one. Okay, when you hire the attorney, they're always going to send you here, revocable, grantor, living. They're never going to send. They're rarely going to send you over here. But when they send you over here, if they send you over here, they're going to put you in the simple category. Okay? So look right here. All of these types of structures right here, you have what's called a requirement. Okay? You have a requirement to distribute income. Okay? And what that means is when the trust makes money, you don't have a choice. When the money comes into the trust, you have to distribute it to your beneficiary. You don't have a choice. That's how the structure is. And then, if you're lucky enough to find an attorney that'll set up an irrevocable trust, he's going to set it up as a simple, not a complex spendthrift. He's going to set it up over here. And this complex spendthrift requires you to distribute. Okay? So both this and this require you to distribute. So what you have to do is you have to have the right structure to get the right outcome. It's like my daughter loves to plant plants. She's walking the room, she has plants everywhere. The roots create the fruits, okay? The structure creates the outcome. So if you have the wrong structure, you're gonna have the wrong outcome. And so every time I do financial planning with people, the first thing I always go to when they first start talking to them was, tell me about your structure. Because that's all that matters. Because you know, and they tell me all these bad things. I'm having to pay all these taxes. Well, most doctors have to pay lots of taxes because the CPA set them up as S-corps. Well, that's the wrong structure for a doctor. It's just a terrible structure. And so, but they think they have to be an S-corp. That's the problem. Is the CPAs and the accountants and even the attorneys say, well, the best thing is an S-corp. Well, it's easy for the accountants and it's easy for them. That's why they recommend it. They don't want the hard. They don't want something that's a little bit harder. So don't let someone tell you what your structure is. So we have a bunch of brochures that we have, and we don't have very many of our brochures here today, but we have a lot of brochures, and our brochures will always explain, don't let someone tell you what your structure has to be. See, that's what they do. They tell you what you have to be, and you think you have to be that, but you don't have to be that. You can choose. Doctors can be C Corps. They can be trusts. You can have a business trust. So I can run a business trust better with payroll and all the things that any other type of business has better. I can run a business trust better than any C Corp or S Corp or LLC. Because guess what? My business trust, watch this, even my business trust does not hold equitable title to anything. So guess what? Now I get to operate my business in a structure that can't be sued. Think about that. If you, that's one of our brochures. It talks about capital gains, which is a good one. So just so you know, capital gains, people paying capital gains tax is normally the number one reason people buy my trust, because what happens is you'll get to a point when you get wealthy enough. Here's what happens: you get to a point where your assets are so big that the income generated by the assets create enough income where you don't need your JLB anymore. Okay, and that's how wealthy people work. They build up their assets, and we show them how to do it, build up in the trust, the right trust. And just so you understand, when you make any of these, there's 6 types of income that when you build up the assets in this trust, you'll never pay a tax on any of these 6 types of income produced. So what am I talking about? I'm talking about, I'm talking about rental income, okay, rents, royalty income. Let's say you have some oil wells or something, or you have some kind of royalty. Rents, royalties, interest income, maybe you make loans to people. Dividend income, maybe you own some stock or some type of investment, you get dividends, okay? Or maybe you have K1 income that's passive, okay? And the last one is capital gains, okay? So there's 6 types of income. Here's how the wealthy work. Well, the wealthy, once they build up their assets in their trust, they make all of their income one of these 6 types right here, and what that does is it takes them completely out of the tax code. They'll never pay tax ever again. And I'm not kidding. And I'm not going to explain how it works. Because and here's how it works. When you have rental income, when you have enough houses or properties in your trust, okay, that creates all the rental income, I'm going to draw a picture just so you understand it. But what happens is you end up creating so much income that's not taxable. And the reason why it's not taxable is because, look right here, there's no requirement to distribute the money. So the money comes into the trust, but you don't have to distribute it down here to beneficiaries like you do over here with the simple trust or like you do over here with all the other trusts. So here's how it works. You have a trust, okay? And this was you over here, and we sold, remember all the houses and the assets, we sold it all in here. But now the house, and all the cars and all the E-Trade accounts and all the money, okay, hold on. All the money in this trust is now coming over here and producing enough income, or let's say capital gains, okay, which by the way, the tax code, which I'll read it in a minute, it says that when these assets create income, or capital gains or whatever it is, if it's any one of these 6, think about this. You can have 20 rental houses in your trust, 20, 30, 100. You can have 100 rental houses. And all the income in from that rental house is not taxable to the trust. Because you get that income, what does it do? Comes back into the bank account of the trust, okay? And the IRS code says as long as you don't distribute the income or require you to distribute the income, okay? So, which is kind of the key here. I'm going to show you where a lot of the CPAs they miss it. Look right here on the tax code here. This is where so the devil's in the details, right? Gains from the sale or exchange of capital assets shall be excluded. Excluded means it's not a gain. So it's a gain, but the IRS says it's not a gain. Watch this. To the extent that the gain is allocated to corpus and it's not paid or credited, here's the most important thing. required to be distributed. See, remember all the irrevocable people and the simple trust people and the living trust people? Here's where they went wrong. Their trust has a requirement to distribute income. They have a requirement. So even if they didn't pay or didn't credit, they still can't do this because their trust is required to distribute. So that's why those trusts are terrible. That's why they don't work. So again, let's follow the bouncing ball. Here you are right here. You have all your money and all your assets. You sell it to the trust that we set up. You could have, again, 20, 100 rental houses. They produce all the income, capital gains, whatever. They could produce rental income, royalty income, interest, dividends, K1, and capital gain. Any one of these 6, as long as the money stays in the trust bank account or pays for trust things. Watch this. So what can the trust pay for? It can pay for any bill that is created by the trust assets. So think about this. 90% of all the bills you pay every month are usually for the assets you own. Your house, your mortgage, your taxes, your gas for your car, the car note for your car. 90% of all your bills are paid usually out of your personal bucket. But when you sell everything to the trust, now guess what? The trust pays not for all those bills. So again, 95% of all your bills will now be paid for with trust money, okay? And so what we do at Nexus is everything we do is done by the tax code. We go by tax code and case law. So a lot of times people will ask me, you know, how is that legal? Or they'll show me that it's not legal. And so I'll actually show them the case law. And so look, in this case law, this is what would happen, and this is how it ended up. So everything is done by trust case law and tax codes and contract law. So and so before I go forward any further, I like to just talk about trust in general, because a lot of people, they don't even know what a trust is. What is a trust, right? Just so you understand, a trust all it is when you take an asset or money or something and you set it aside for the benefit of someone else. That's what a trust is. Okay? Have you ever been into a bank and when you open an account, they said, do you want to fill out this TOD form, transfer on death? Okay, most people don't know that they're actually creating a trust when they do that. It's called a Totten trust. Okay? So when you go into a bank, you fill out the form, you open the bank account. Oh, by the way, fill out this real quick form. In case you die, your bank account goes to your family or whomever. That's called a Totten trust. All it is it's a simple document that says, you know what? If I die, I'm setting aside all this money in this bank account for the benefit of someone else. And so that's a trust. Okay? That's all a trust is setting aside something for the benefit of someone else. That's what a trust is. So it's not a complex idea. The first person in a trust is a settlor, okay? The settlor is simply the person who creates the trust. So are you going to be the settlor of your own trust? No. Because this is where all of the people make the mistakes. If you are the settlor of your own trust, that's how the government won't give you any benefits. Okay? They won't let you have asset protection. They won't let you have any tax advantages if you're the settlor of your own trust. So when you call up the attorney and say, hey, Mr. Attorney, I need a trust, what's the first thing he does? He says, okay, well, let's set you up a trust. And he does a revocable trust, a living trust. He does the wrong one, right? But he always makes you the settlor, and that's where he messed up. He makes you the creator of the trust. All the benefits, right? In the irrevocable complex Sphincter, all the benefits come right here, and they come because you are not the settlor, or you are not the grantor of the trust. So we never want to let you be your own settlor. It has to be someone other than you, okay? Trustee, that's just the person who manages all the money and assets and everything, makes any financial decision is made by a trustee, okay? Beneficiary, those are the people that you eventually want to give. You don't want to give them the asset or income, but you want to give them beneficial interest, okay? Where you make a mistake is where you actually let the beneficiary have the income or the asset. No, don't give them the money. Just let them drive the car, let them live in the house, but don't give them the money. Now, if you want to give them money, we can show you how to give them money. Okay, you just don't do it from the trust bank account. And the secret to that is anytime you sell all your personal assets to the trust, you get what's called a demand note. Okay, So all the value of everything you put in the trust now owes you the value of that. So let's say you have $1 million in assets right now, $1 million. You sell all the trust now owes you $1 million because it bought the assets from you, right? So if you want to give your kid, $100,000 to go blow at the casino, you give them the $100,000 from your demand note. You don't give it to them from the trust bank account. So you can give them money, you just have to do it from the right place. And because a lot of people are like, well, I want to give my kid a $500,000 house. They want to give them something. Well, I tell them, well, let me explain something. If you're going to take all your assets out of your personal bucket, where you own nothing and control everything, why would you want to fill your kid's bucket up with something? Right? You're setting him up for a lawsuit if you do that. Why? Because all he has to do is have one creditor say, you know what, Judge, your kid gets one debt or your kid or you or anyone, you're one car wreck and one IRS letter away from losing everything you own. Okay? And that's just the reality of the facts of the situation. So if you're going to take everything out of your bucket, put it in a trust, we don't want to teach our kids to put a bunch of stuff in their bucket, right? So don't let them put it in their personal bucket. Make them a trustee. Let them manage assets. So say, you know what? Here's your $1 million, but you're going to be a trustee of this money over here. Make them a trustee. And now they can't be sued. Now they can't lose the asset. So when the client comes to me and says, this is what I want, sometimes we have to help them see a different way of doing the same thing. Because again, you don't want to lose your assets. You don't want to invalidate your trust. You don't want to cause taxable events. Okay, so let's go here. History of the Sphincter Trust. So this trust literally started almost 500 years ago. It's called the Sphincter Trust. King Henry VIII set up the first European common law trust. And that trust has been around since the 1500s. Some people say that the trust that he set up and was made famous for, they say that it came from other countries, like the Anglo-Saxons brought it to England, and then some other people on some websites will say the Anglo-Saxons got it from Roman law. So the trust has been around forever. So the idea of putting something in a trust, don't be scared that it's some new creation that we just thought up. It's been around forever. So but all this to say, the trust is the structure of choice for the wealthy. Okay, and I heard this saying one time: if you want to be wealthy, you need to do what the wealthy are doing. If you want to make the kind of money the wealthy are making, you need to go where they're making the money at. If you want to be like the wealthy or have what they have, you should probably do what they're doing. And this is what the wealthy do. They don't pay taxes. Literally, they make all their income, rental income, royalty income, interest, dividend, K1, or capital gain. This is where they live. They live and die in this type of income and never pay a tax. Why? Because their trust is earning, watch this, it's earning all these 6 types of passive income, and all the money just goes right back into the trust. They may have rental houses, they may have buildings, they may have all these different investments coming into the trust, but guess what? They're never paying a tax. Why? Because it's all passive, and the tax code is very specific. As long as it's one of these types of passive income, you can allocate to corpus. The corpus is the body of the trust, all the assets. If you allocate to corpus, and the IRS says, now these are not my words, okay? These are the IRS words. Look right here. I'm going to show you at the bottom of the screen here. Right here. It says, if you allocate to corpus under the terms of the trust, which is the governing instrument, shall not be considered income. Now, this is not me saying that the 6 types of passive income is not income. It's the IRS saying that it's not income. So think about this for a minute. You have your trust. You have 100 rental properties, right? They're producing literally millions of dollars in rental income. The rental income's coming into the bank account, and the IRS is saying it's not income. It's not income. Because why? Because we do not distribute the income to beneficiaries. Okay? We don't do this like all the other trusts do. You don't distribute. It's not income. Because, in other words, the corpus just gets bigger. It's like a snowball. It just keeps getting bigger. Okay? So, it's not me saying it's not income. We do everything by the tax code. So, the problem is this type of stuff that you're learning right now is not taught anywhere in this country. You're not going to hear it from anyone because they only know what they've been taught. They're only going to teach you what they've been taught. And if this isn't taught, you're not going to hear about it. In fact, there's a financial incentive for them not to teach you about this, right? If you say you have a business down the street, and the super wealthy also have a business down the street, it's to their financial benefit that you don't know this information, right? Because guess what? They now operate on 30% more revenue than you get to operate on. So think about it. If your business is now operating on 30% more revenue, think of how fast you could parlay your business. Advertising, whatever. Okay, so let's go back. Now, does anyone have a question so far? Anyone? All right. Sometimes we get to talking and you have a question, and sometimes it's good to ask a question when you're thinking about it. So we have a lot of brochures. This is just one of them that says, "Are you a doctor, professional, or business owner?" Right? If you're a doctor, professional, or business owner, we can help you. What that means is if you're not a doctor, professional, or business owner, you probably don't control your income. In other words, if they're making you be a W-2 employee, tough. I can help you. I cannot help you because if they're telling you how you're going to pay your tax, you don't get to choose how you're paying your tax. So what my goal is to do is get people to realize, like the doctors, don't go to the CPA and let the CPA tell you have to be an S corp. That's what they're going to do. They're going to say you only have to be an S corp, but you have to pay yourself a reasonable salary. So every doctor is sitting here paying $50, $75, $100,000 a year in taxes only because their CPA told them they had to. But that's not true. Don't ever believe that. We have 30 or 40 doctors that we signed up in just the last year that are trusts. They have a business trust set up. They don't even have a C corp or S corp anymore. So there's no requirement to be a C corp, S corp, or an LLC. There's no requirement. You can choose it. So first question is, how would you like to legally reduce your tax bill 70 to 90%? We can actually reduce it by 100% if you set up if you get your income set up right? What if you could legally reduce your capital gains to 0? How would you like protection from eminent domain? Did you know you can get 100% asset protection, meaning no court has the right to ever take an asset out of your trust? By the way, your trust is a private document, which means your trust book that we give you can never be opened in open court. No prosecutor has the right to ever see your trust. No IRS agent has the right to ever see your trust. The only person that has a legal right to see your trust is the judge in his private judge quarters. That's it. Think of how powerful that is. Only you and the judge have the right to look at the book itself. That's pretty powerful. So what if you can eliminate the taxable estate problem? No more estate taxes. Yesterday I bought the domain what did I buy? It's nodeathtax.com. So I did it because we have farmers that lose their farms. So in about a month from now, I'm working on a video. So we're going to have a website, nodeathtax.com. Because right now we already have nocapitalgains.com. So we have a video there you can watch. It's just like 2 minutes long, but we're going to target farmers that are losing their farms because when their grandpa dies, it's over the threshold, the 12 million or 15 million, whichever your state is in, whatever state you're in. But there's a threshold. After a certain amount of millions, you start losing your farm. You lose the money. You have to pay a death tax, right? Well, that's what I'm saying here. No estate tax problem. You can eliminate the taxable estate. Your trust can have trillions of dollars in it, and you die, and there's no tax due because the trust owns everything. You don't own anything anymore. The unique trust structure eliminates the pitfalls of living trust, allows you ultimate control from the grave. So here's what I like to do. I'm going to erase this. Brian, can you erase this for me? Sure. Okay. So what I like to do is explain to people. When you set up a trust gives you what's called control before the grave, control at the grave, and control from the grave. So that's what a good trust will do. Now, living trust Okay, now most people have living trust, right? So remember, there's three types of control. Control before you die, control at the moment of your death, right? And then control after you die. So what I like to do is take a marker, watch this, and I just draw a big long line, okay? Now, and you ever go to the eye doctor and they say, which looks better, A or B? You know, all you do is choosing, which one do you like? Do you like this or this? Okay, so this is the moment when you die. And I'm going to show you which looks better. Would you like to have the living trust that everyone buys, and you only get control here, okay? So with the living trust, this is how it works. It does provide one benefit, and it's control at the grave. It does provide control at the grave. It means right when you die, you have control at one moment in time. What happens at that one moment in time is your assets get to pass from you, okay, to whomever you choose. Okay? So it does have a benefit. A living trust does have one benefit. You get control at the grave. The problem is, like I said, my favorite slide was the 5 living benefits, right? I want to have living benefits. I want to have benefits when I'm living, not when I'm dead. In fact, you don't even have benefits because it's not even a benefit. If you're dead, you don't even get to see the benefit. You'll never see the benefit. Why do you buy a trust when you can never see the benefit of your trust? So I like to have living benefits. So first living benefit, again, control from control, asset control, right? Control the assets. We're going to have asset invisibility, right? Because we don't want anyone to be able to even know you own the building next door, right? Sometimes you can make money by rich people sometimes will own a lot of assets in the town that they live in, but the people in the town don't even know they own the assets. And they get to, it's kind of sad, but they can manipulate people by them not knowing if they own. So asset invisibility is a benefit. Control of assets. So you can have living benefits, and then you have the one death benefit. But here's the biggest one, is what we call control from the grave. So with our trust, again, I don't just want the death benefit right when I die. I want living benefits until I die. I do want this when I die, but then I want control from the grave for the next, 1,000 years? Or 2,000 years, okay? Because with our trust, watch this. We not only have a trustee, but we also have a trust guardian, okay? A trust guardian is a position that can add or remove trustees if they don't do what you tell them to do. So watch this. When you're alive, you make a directive. You say, hey, for the next 50 years, I want you to pay my church $5,000 a month for the next 50 years. If you don't do it, the guardian, the successor guardian, is going to fire you. In other words, you get control from the grave, because guess what? If the trustee doesn't do it, the guardian fires the trustee. Okay, so you only get control before the grave, control at the grave, but get control from the grave. So it's pretty powerful trust. And so most wealthy people, they like to control the next 1,000 years. You know what? I'm gonna make $10, $20 million. When I die, guess what? I want that 20. I want all my grandkids to get this. You get to do whatever you want. But guess what? If the trustees don't do what you want, you can say, you know what? The successor guardian is going to fire you. You know. So it's pretty cool. All right. Does anyone have a question so far? Anyone? All right. And now we have a brochure called the Executive Summary. If you were invited here by a consultant or someone, all our consultants have an executive summary. And they can give you their executive summary, but the executive summary will answer 90% of your questions about our trust. And then watch this: at the end of the executive summary, it should have their contact information on the executive summary. So, so if you don't have an executive summary yet, talk to April or talk to whomever invited you. But what I will tell you is that probably the document that most people like to read is this one. It's super simple. The 6 types of passive income not considered income to the trust by the IRS. Now, there's one disclaimer. It says this type of trust must be irrevocable, complex, and the income must be allocated to corpus by the trustee, not distributed, to not be considered income by the IRS. So, again, as long as you're making this type of income right here, you're not making active income. Because what you have to understand is there's two types of income. There is active income. Okay, now, like an active income, you have to pay the tax. Doesn't matter if you're John Rockefeller. If you make active income, you're paying tax. Okay, or there's passive. So you have active and you have passive. Well, guess what? The tax code allows us, if it's passive, guess what we get to do? Remember the 6 types? We can allocate it to corpus and not have to pay the tax. It's passive. So here's what we do. If you have a sandwich shop, any type of business where you're creating active income, if you're an insurance agent and you're selling insurance, you're creating active income. Anything, most people will create active income, even doctors, right? Doctors come to me, they have a practice, they have a doctor, physician clinic. They're creating active income. What do you have to do? What do you have to do if someone does create a lot of active income? It's real simple. We turn the active income into passive income. That's the trick. So how do we do that? Well, remember the 6 types of passive income. All we have to do is make the income one of the 6 types. So let's talk about that. Let's say you're a C Corp, or you're an S Corp, or you're an LLC. Okay? These are the most common structures people have. Okay? So we'll talk about that. Here's all of them. Let's say they're all making active income. Okay? Again, let's say it again. If it's active income, you have to pay the tax, no matter if you're John Rockefeller or Bill Clinton. It doesn't matter who you are. You're paying the tax. Even Trump, whatever. You're paying tax if it's active. So what do? They turn active into passive very creatively. They have a good financial planner. Okay? So let's say it's a C Corp. And now we set up a trust down here. We're going to help them. We're going to help them turn their active into passive. Okay? So they have a C Corp. How are we going to turn all this? Let's say they're making $1 million in active income every year. Now, how are we going to get that money down here without having to pay a lot of taxes? Well, the first thing we're going to do is we're going to tell all of these people right here, the LLC person, the S Corp person, and the C Corp person, the first thing I'm going to tell them is you don't have to be one of those structures. If you cannot afford to set up a business trust, then I will still help you. So there is a such thing as a business trust. It's the same trust as this one. This is called a beneficial trust. Let me just write it down here. So again, this is a beneficial trust. This is a business trust. Okay, they do cost money to set up. If you only have money to set this one up, then what we're going to do is we're going to take your active income up here. We're going to turn it passive and get it put it down here in your beneficial trust. And one day, when you have the money, set up your business trust. And because here's why you don't want these structures up here. Okay, these structures up here are very easily sued. Okay, in fact, LLC they say stands for large lawsuit coming. It's coming. So just get ready. So the problem with these structures is you can be sued. Do you really want to operate your business in a structure that can be sued very easily? No. And the only reason they're sued is because these 3 structures are called statutory. Okay? They're called statutory entities, meaning the state is the one that created them. You have to go to the state of California here to set up a C Corp, S Corp, or LLC. Not only do you have to go to the state, you have to pay a fee every year. What is it, $1,000 in California?
It's like $800.
Yeah,
$800. Well, $800 a year just to taxes.
So it's statutory, meaning not only is your state the one that sets it up, but the state's the one you pay every year. The state's the one that controls all the rules every year. They control everything. So what we want to do is we want to create a structure that's not statutory. Okay? Now, guess what? The states have no jurisdiction in your trust anymore. They have no say as to how you operate your trust. They have no say. You're still going to follow the laws, but they don't get any say into this business trust. Okay, so now let's go back here. Remember, you make $1 million in a C Corp. What are we going to do? We're going to set up a lease. Okay, remember the 6 types of passive income. Rents, royalties, interest, dividend. Right? We're going to set up a lease, a rental income. What are we going to lease? Well, the C Corp no business can run a business without equipment, desk, computers. You know, every business has something it leases, right? So you have equipment lease, okay? But you also have what's called IP. Every business has IP. They just don't know it. Okay, every business. It's intellectual property, okay? The name of the business is intellectual property. The list of all the customers is intellectual property. There's something called goodwill. Goodwill is your reputation in the community. That's intellectual property. You can lease your goodwill you can lease your goodwill that you own to your C Corp. Okay? There's a whole, what we do is we help our clients create their IP. We even have a trademark attorney that works for us. He's the best in the country, and in fact, he has hundreds of attorneys that will use his service, and they'll charge $5,000 for the trademark. He only charges $1,000. You know, and so they get to make that difference between. So, you know, we have the best trademark attorney. He's only going to charge you about $900 to do it. He'll set up your IP, your trademarks, everything. But what you're going to do is you're going to lease all that up here. So you're making $1 million. Well, guess what? 70% of that million is going to travel, okay, of net, right? Because you make $1 million, that's not your net income. You don't pay tax on $1 million. You have expenses, right, and payroll. So after $1 million, what do? You have payroll, you have expenses, right? So you're only going to pay tax on what's left over. It's called net income. But 70% of your net's going to go into your trust, never to be taxed again. Okay, the only taxable income left is 30% left. Okay, and then so I can show you how to cut your taxable income with a C Corp or S Corp by 70% using a lease. Now the LLC is a little bit better situation here, because watch this. Here's your beneficial trust. I can set the beneficial trust to be a LP, a limited partner of your LLC. All you have to do is take your operating agreement, amend the operating agreement, and make the trust a limited partner. That's all you have to do. And so now the trust is a limited partner LLC. So let's say your LLC makes $1 million a year, right? Okay, you have payroll, you have expenses, whatever your net income is, guess what? Now 90% of your net income gets to travel from the bank account here to the bank account here, and it's never to be taxed again. 90% of your net income. Why? Because it's limited partner. Look right here. Remember, one of the 6 types of passive is K1 passive income. Right here, K1 passive. Well, guess what? The income from your LLC is a K1 that goes from here down to here. It's K1, it's passive. Now, the trust does not own the LLC. It only owns the income of the LLC. Have you ever watched that show, Shark Tank? And you'll see Mr. Wonderful. He'll say, you know what? I don't want to own your business. I just want a royalty. See, he's smart, because all he's doing is he's sucking out the income without owning the income, or without owning the company. He doesn't want to own the company; he just wants the income. And so, and that's what you're doing here with the LLC, because the trust is owning 90% of your net income. It does not own the LLC; it just owns. Why? Because the other 10%, guess what, goes to your personal return, because that's active income. So you just took $1 million of active income, and you pay payroll and expenses. Whatever's left over is your net, and 10% of net is now taxable instead of 100% of net. Okay, so that's pretty cool. But this shows up on your personal return, the 10%, because it's a K1 that goes to your personal return. You pay your tax. You always pay your tax on active income. We're just going to show you how to make most of it passive, right? But again, the best structure ever is the business trust. Why? Because we're going to be able to do the lease program with the business trust into the beneficial. So watch this. This is all your active income. All your active income comes here. Okay? In fact, I have clients that have a business trust. They have 5, 10 different businesses. And all the different businesses use this one business trust right here. Because you only need one business trust. You can have 100 businesses with only one trust. What do? You get DBAs. They're like, do I have to lose my name? I mean, no, you go get a DBA for the same name that you have, and you're the one that has the right to the DBA, no one else does. So you never have to change your names, okay? But your business trust can operate as many businesses as you want. It's all active income, but guess what? 70% of the net income is lease income that goes into this trust. Well, guess what? There's still 30% left of the active income. Remember, active, you have 100%. 70% is the lease. That means there's 30% left in active income. What happens to that 30% that's left over? Well, guess what? This is a business trust. Business trusts do not have shareholders. They do not have limited partners. They have beneficiaries, right? So who's the beneficiary of the business trust? The beneficial trust. So that 30% goes from here down over here to the beneficial trust. But watch, it's coming in as active. It's not coming in as passive. So what do when 30% of active income from a business trust comes into the beneficial trust as active income? Well, beneficial trusts also have what? Expenses. Right? Yeah, the beneficial trust owns assets, owns cars and houses and all these things. So guess what? You get to do what's called trust accounting. So now the 30% that's taxable, right? Remember, 70% was non-taxable. Why? Because it was passive. Remember, we don't pay tax on passive income, right? But 30% is still active. So guess what? The 30% comes in here. It's active. You got to pay tax. However, not so fast because you have expenses. This trust has its own expenses. So you get to deduct, when you do trust accounting, you get to deduct a bunch of things. So this 30%, okay, will be wiped away down to about somewhere around 15 to 17%. But guess what? It's 15 to 17% of the 30%. It's not 15 to 17% of the 100%. It's 15 or 17% of the 30%. Because why? Because you have a lot of trust expenses in here that will wipe away the active income. So you're going to get, so if you use a business trust and a beneficial trust, you're going to take, you're not only, you're going to keep yourself from ever being sued in your business, but you're basically going to cut your tax bill in, again, 95%, roughly 95%. It's a better deal than even the LLC here at 90%. So, but again, you got to be able to afford it too, right? Because you know, if it's worth having, it's worth you got. There's a cost for everything, right? So, so that's the basic presentation of how the trust works. Now, what we can do is we can go into our PowerPoint. I do have about, let's see, I have at least 30 or 40 more slides we can go through. Or I can take questions and answer your specific questions. That's what we like to do. When we do our training calls on Thursday nights, what we like to do is just answer people's specific questions. And then what I do is I'll use my PowerPoint slide to answer the questions. So does anyone have a specific situation or question?
I seen something for the businesses. You said that you don't need liability insurance.
That's correct. Yeah. So here's how it works. When doctors come to us, they have stuff in their personal buckets, right? And the whole reason you need Brian, can you do this again? The whole reason a doctor wants to pay for malpractice is because what happens? What happens when a doctor gets sued? They lose what?
Money.
They lose money, but they lose what kind of money? Personal or business?
Goodwill and business.
They lose personal money.
Yeah.
Right? They can lose personal money when they get sued. So what they do is they get malpractice, so they can't lose their home and all their stuff. You know,
Lose their reputation too.
Yeah, if you get a judgment, right? You get a judgment, they can come after any asset that's not your personal residence. So anything that you own that's not your personal residence. So with this trust, okay, you have no need for professional liability insurance anymore. Why? Because you don't own anything. There's only two reasons why an attorney will sue you. Only two reasons. Income, or, well, there could be three reasons. I'll just say that. But it's usually two reasons, assets or insurance. If you have assets or if you have insurance, they're going to sue you. Guess what? If you don't have personal liability insurance, what are they going to take if you don't own anything? So that's the beautiful thing is that, you know, they're going to first ask the doctor, do you have personal, you know, do you have malpractice? No, I don't carry malpractice. What? You're a doctor, you don't carry malpractice? No, because you don't have any assets to protect you. You know, you don't have. The only reason you buy malpractice is to protect your personal bucket, right? Because remember, even if they have a C corp or S corp, remember the liability is limited. So they're protecting personal assets. Because guess what? They don't put assets in these entities right here. because they don't want to, remember, assets are insurance, right? When they do the malpractice, they personally own the malpractice. They don't put the malpractice on the, and if you don't put assets in here, the attorneys, remember, there are only 2 reasons why they sue. They might sue for income, but a lot of states have charging order protection. So I'll put this, I'll put 1, income. They'll sue for income. If you're in a state that has bad charging order protection, assets, they'll sue for assets, or 3, they'll sue for insurance. This is the number 1 reason why they sue doctors, is for insurance. Okay? But they know, because they know that these entities don't have any assets. And the insurance is usually on personal assets. So if you have our trust, you have no need for professional liability because you don't own anything where they can't pull blood from a turnip, right? So, and if they use a business trust, that's why we tell our doctors, use a business trust. Now they can't even sue the business. They can't sue you personally. Well, they could, but they won't get anything, right? And even if they get a judgment, it'll fall off in 10 years on your credit report, right? So in 10 years, the judgment falls off, and So I had a client call me. He's like, "Man, I just got in a car wreck, and they're trying to sue me." And I said, "Well, don't worry about it. All your assets are in your trust. The trust doesn't hold equitable title to anything. So tell the insurance guy, you can sue me, but you won't get anything because the trust owns the car, and the trust does not hold the equitable title to the car. So you're going to have to sue me personally, but I don't own anything. So even if you win in court, you'll get a judgment. In 10 years, it'll fall off." So the guy, he told that to the insurance guy, and the guy never called him back. So it works. So, but before I end, I would like to tell you real quick. When you set up a trust, it's a bucket. Remember, you put stuff in the bucket. And the number 1 thing we like to put in our bucket is insurance. Why insurance? Because insurance can parlay the money in the trust better than anything. Here's why. Watch this. I have this trust right here. Now I'm just going to show you hypothetical. Here's the trust. Even if you're a trader, you're a Bitcoin guy, even if you're the best crypto guy out there, watch this. So I'm going to show you. Remember I said if you're at the eye doctor, they're going to say which looks better, A or B. Okay, watch this. I'm going to show you Bitcoin Brian right here. You got Bitcoin Brian and you got the trust. Which one's going to be better, Bitcoin Brian, or are you going to have the trust? Now this is a trust that has life insurance. Okay, watch this. Okay, now let's say both people have $1 million to invest. Okay, so you have $1 million. You get to invest in Bitcoin Brian, or you get to invest in the trust that has life insurance. Now watch what happens. You put the $1 million over here. Okay. Bitcoin Brian puts the $1 million in the Bitcoin. Now the trust puts the $1 million in the life insurance. But watch this. Bitcoin Brian puts the $1 million, and guess what? The Bitcoin can go up or the Bitcoin can go down. But you can also put the $1 million in the life insurance. But watch this. You can immediately take out 80% of the money you put in the life insurance and go put it in the Bitcoin. Okay, now watch this. Bitcoin can go up or down. But watch this. At the end of the day, if Bitcoin Brian loses his money, and let's say Bitcoin goes down and both people lose their money. The beauty of the life insurance is, watch this. The person here could die. If Bitcoin Brian dies, his family gets, if Bitcoin goes down, right? If he dies, his family gets the value of the Bitcoin going down. If this guy dies, he gets, every policy has a death benefit, right? So even if the Bitcoin goes down into life insurance, the trust is going to be immediately funded with millions of dollars. I'm talking millions of dollars. So the trust won over Bitcoin Brian. Now watch this. Let's say the Bitcoin did not go, let's say the Bitcoin did not go down and it went up, okay? And Bitcoin Brian did not die, and the trust, watch this, you can take the money out of Bitcoin, even when it goes up. You can come back here and put it back in the life insurance policy, and the way the contracts are written is the insurance company has to credit you the interest and dividends, depending on the contract. It has to go back from the day you took the money out and put it in Bitcoin. It has to come back and credit you the interest that your money would have got had you left it in there. It still has to credit you the interest. So whether or not your Bitcoin goes up or down, it still has to credit you that interest back. Okay? So what I'm saying is, the person here is way ahead of Bitcoin Brian because he only gets the value, either good or bad. This person right here gets not only the value of it going good or bad, but let's say it goes bad. He can come back and put the money back in here and get credited all the back interest and dividends and stuff and be way ahead of Mr. Bitcoin Brian here. And so, in other words, with the life insurance, you get to take your money out of the policy and still go invest like Bitcoin Brian did. But when he dies, he gets nothing. When this person dies, they get everything. So you get your cake, you get to eat it too, and you get to invest in whatever you want to. Some people take I have a client right now that pulls money out of their policy and goes and flips houses and puts them back in the policy. And guess what? Even if it took him a year to fix his houses up and sell them, flip them, he gets all the interest for the whole year, even though the money wasn't there, because he took the money and put it back in the policy, and the insurance company has to go back to the day that you took it out and credit you all the interest. So you never lose the money. You never lose the money. Never lose the value of the money of it, even if you take it out to go do something. And yeah.
So is the life insurance in a trust name or your name?
You want the trust to own it itself.
So you can get life insurance on a trust?
Sure. You have to trust. No, the life insurance is on the person, but the trust is the owner. Let the trust own the policy, right? So, because again, you don't want to own it personally. Why? Because you don't want anything in your personal bucket.
Right. Well, that's what I say. If you have a life.
Yeah, because that's how you don't want to give someone a target to sue, right? So you don't want to own it personally. You want to let your trust own it. But all I'm saying is with the insurance policy in the trust, you get to have your cake and eat it too. Would you like to expound on what I'm talking about?
No, you did. Yeah, good. But going back to kind of the synergy, right, between Scott and with the trust, and then also with like the cash flow strategy, it's having just adding that extra thing where we can have the life insurance be owned by the trust, but on top of that, paying it back, great, if you want to pay it back, but the way that we design it efficiently, you can keep borrowing against the policy, but the death benefit is large enough, so it's a delayed gratification for the insurance company. So we design them where you can continue to borrow. So back to Bitcoin Brian, he can have an insurance policy, borrow against the policy, go lose his butt in Bitcoin, right? And never pay it back and know that that loan's gonna be paid. So he loses his behind, right? He loses all of his money, but he didn't lose out on what that money could have earned him. And that's the opportunity cost, right? Have your cake and eat it too. Have both. Mitigate your risk, right? So what he's doing is he has a life insurance policy. He has his money earning uninterrupted compounding growth, close to 7%, tax-free. But then when he borrows against it, he's using the insurance company's money. And he's playing with house money here. So if he has an upswing, shoot, he has the uninterrupted compounding growth there, at least at 3%, plus he has all the money from Bitcoin. It's like,
and if he dies, the
why
trust
not
gets
have
millions.
both? Yeah, it's like it's
So-
brilliant, So I love the synergy between the two because we can really lightning.
Can you take like a K1 income that's already K1 income from say a family trust and put it into a beneficial trust and have the same advantage, or is that double dipping?
The problem is the K1 income coming from your family trust is usually active. That's the problem.
It is active, yeah.
And if it's active, we've got to put it into something and turn it passive. So you could have your K1 income going into an LLC. Now 90% goes to your trust.
Can you get personal rental income and like active income go into, or the beneficial trust, or is still active income is always active income?
it all comes down to ownership. So what you have to do when you set up your personal trust, you gotta get your assets in the trust first.
Yeah.
So that all the rental income comes back to corpus. So.
So active income is always active income.
Yeah, and so my point is that it doesn't matter, the first thing we always look at is ownership. If the trust doesn't own it, it can't benefit from it.
Okay.
So if you own it, then you're gonna pay taxes out the nose. So you don't want to personally own your rental properties, you want the trust to own your rental properties.
So is that because it's distributed as a beneficiary?
That's
Like,
right.
So he's a beneficiary.
That's right.
So then
Because
it's
remember,
been distributed already.
the tax code says if it's a revocable trust, if it's a simple trust, if it's a living trust, all of those have to distribute all the income. They don't have a choice.
Well, how about if it's an irrevocable complex trust, but it's still distributing to the beneficiary?
Yeah, even if it's an irrevocable, complex, spendthrift, everything is perfect. Remember, the tax code says if you're required, if you do it or you don't do it, or you let me see if I can show my screen here. Here it goes. Yeah, those are great questions though. Okay, here it is. So right here, it says as long as you're not paid or credited or required to be distributed. So the complex is not required to distribute, but the fact that you paid or credited the beneficiary, you have to pay the tax.
Oh.
Yeah. As long as you don't pay or credit the beneficiary, you don't have to be taxed. As long as it's this structure here. So, yeah. But if you pay, there's three things. If you pay, or you credit, or you're required to be distributed, or you're required to be, then you have to pay it. You don't have a choice. Even if you're the right structure, but you pay a beneficiary, you have to pay the tax, you know? Because remember, complex, so even if it's complex, the rules are always the rules. So if you distribute, you always pay tax. Yeah.
So if a business trust owned my corporation, the income from my corporation could then go to a beneficial trust?
So the business trust, the business trust can operate the business, but the trusts are not allowed to own it. The trusts are not allowed to have management control of anything. So the trust can't own the company. It can operate the company, but it can't own the company. Because if you own the company, guess what? You're getting K1 active income, not K1 passive. If you're an owner, you're going to pay active income.
I get it.
So if you have let's say you have a business. What you want to do is you want to make sure, you always want to make sure it's passive, not, so when people ask about ownership, can it own this or own that? A trust can actually own 49% of anything. It just can't own 50 or have any kind of management control of anything. Because that's not the purpose of a trust. The purpose of a trust is to, it's just not the purpose of a trust to own and create active income. So, at least our trust. So, we don't want to pay taxes, right? So, so if you have an entity, what you do is you end up, you can operate your LLC or your C Corp or your S Corp, but you're saying if you have a business trust. So if you have a business trust, you don't need the S Corp or C Corp or LLC, because all your money can come here first and then be distributed down here to your beneficial trust.
Okay.
So you don't even need this anymore if you have a business trust.
And that's what I'm doing this year. Like, I have an LLC, and I thought I was like the smartest person, like structuring myself. I have like 3 LLCs, and I'm paying $800 a year, every year, to the state. And it's just because I had these 3 different businesses, and I was structuring. But now I'm setting up my trust, my business trust, and then I'll have a beneficial trust. So I'm getting this all structured, too, and just closing down my LLCs. There's no reason for it, right? So if I could do it right, I'm just going to do it the best way and structure it out and mitigate my tax burden completely.
Yep, because if you have an LLC, large lawsuit coming, yeah.
Do you file the tax return? And then what do you charge per year to file the tax?
Our accountant charges $2,000 a year per trust, per beneficial. If you have a business trust, it's a little bit more, it's $3,000 a year. But it includes all the trust accounting too. So you have trust accounting and the tax returns. It doesn't include bookkeeping. Bookkeeping is not expensive though for most people. It's $50 a month per bank account. So it's not expensive to do bookkeeping, but.
And do you help people put their properties into the trust?
Yeah, that's our
Do you
job.
create deeds? and
Yeah, we do
therefore us to work
every
with the county?
everything you need. Bill of sales, warranty deeds, the quitclaim deeds, assignment of notes, if you have mortgages, we create the documents for you. When you buy a trust, we give you a retainer of 45 hours.
Okay, and then when you put your properties into the trust, just so you know, we have something similar.